Imagine you have $100 today. You have two choices: spend it now, save or invest it, and receive more money in the future. The extra money you earn for waiting is what we call interest. This is why we say interest rate measures the time value of money. A dollar today is worth more than a dollar received in the future. What is an equilibrium interest rate? An equilibrium interest rate is the rate of return that balances both the borrowers and the lenders. Borrowers want to pay the lowest possible interest, while lenders and investors want to earn enough to make lending worthwhile. So, the interest rate at which both are satisfied is called equilibrium interest rate. It is known as the required rate of return because it is the minimum return investors expect before investing their money. For example, if investors require 10% return to invest in a company and 10% is the equilibrium rate of return for that investment. Why do different securities have different interest rates? Not all investments have the same level of risk. Low risk investments, such as government securities, usually offer lower interest rates. Now, high risk investments, such as shares of a company, must offer high interest rates to attract investors. This is why financial securities have different equilibrium interest rates. Now, interest rate as the opportunity cost of current consumption. Choosing to spend money today means giving up the opportunity to earn interest by saving or investing it. Therefore, the interest rate represents the opportunity cost of current consumption. For example, if the 1 year interest rate is 5% and you spend $100 instead of saving it, you give up the chance to have $105 in 1 year. This extra $5 is the opportunity cost of spending today. Interest rate at discount rate. Interest rates are also called discount rates because they are used to calculate the present value of the future cash flows. Imagine if you can borrow or invest money at 10% per year, the future payment should be discounted at 10% to find their value today. Example, if you will receive $100 1 year from now and the interest rate is 10%, its present value can be calculated by this formula. Let's first convert the 10% into decimal by dividing it by 100, which comes out to be 0.10. Now by using the formula, we get it $100. This means $100 received after 1 year is worth $100 today.